Hello and welcome to Pepperstone's first edition of the Learn It Live series. My name is Tyrone Abella and I'm joined here tonight by Thomas Atkinson, who is one of our head analysts at educators at FX Evolution. I'd like to thank you all for joining us tonight as we talk about a rules-based approach to technical trading strategies, focusing mainly on support and resistance.
Hi everyone, good to be here. So I'd just like to start tonight. Obviously, we've got the risk disclaimer that we usually need to go through. So this presentation / documentation is purely for educational purposes, and the information in this presentation / documentation is of a general nature only. It will not and does not take into account your specific needs or circumstances, and you should look at your own personal situation and requirements before making any financial decisions and seek independent financial advice if necessary. So what we're going to be covering tonight is a little bit different from some of the other webinars you've probably seen before. We'll actually be taking a look at some technical theory to start with, and then in between that we're going to look at some real, history examples, and we're also going to look at some real live examples in the market that have either played out over the last week and also some that may play out over the next week. So we're taking a look at those pretty fast into tonight, probably about 10 minutes in. We also then will take a look at the economic outlook a little bit later on, just before question time, and we will be doing probably about 15 minutes of questions at the end. So if you stick around to then, you'll be able to ask them in the chat, and we'll cover hopefully a few of the good ones. So just to get started, obviously a few people have probably seen this before, but the idea of support and what support is. So I'll just get the highlighter pen out for a second, and we'll take a look at how to identify support in the market. So support really is a point in the market where basically price has stopped and price has found buying support, or people have taken profit and people are therefore looking at maybe buying it or seeing value in this particular currency pair or index. So let's just say this was the Australian dollar and it was 80 cents. The market was selling off down to 80 cents. Then at 80 cents, people would be considering to potentially take profit at 80 cents, and then maybe we'd be seeing some buying support coming in there where people considered the Australian dollar cheap, and we'd see buying, and then again it would come down to that point and we would see again some form of buying. So this is what we call support levels. Sorry about that. And then we've got basically this level here. And this is like a psychological level where buyers are finding a point where they'd like to purchase. So what we want to do in the market is when we find a support level, we see how many times it's been touched. And the more times that something's been touched or more hit, the more times it's more likely to happen in the future. So here we can see that the point has been hit 3 times. Now the reason why support works so well is that the more or the longer the time frame as well, we basically see sorry, I'm just having one technical difficulty. We basically see that the support has been hit multiple times, and that if it's a long time frame like a daily, more people will see this level. So if this was a day and we saw the candle come down here and then a week later it came down there, do you think more people or less people are going to see this point? I think we're going to find that more people are going to see this point because more people see the daily candles.
So with support, like anything, the bigger the time frame, the more important the support is. There's no real rule that we apply for how many touches there are in regard to when you can trade it. It's just more important that it's had at least 2 solid touches from a trend coming down, or if indeed we're going to look at resistance in a second, a trend moving up. So there's no hard and fast rule that if it touches 3 or 4 times, it's going to break on the next level. We consider a support level support until it does finally break.
So here, as we can see here, the market's come down for a 4th touch, and in this case, many people have obviously seen this point and they're looking at buying from it. The idea of support is that when we see this, we want to be purchasing at this point and then obviously profiting from the upside push of the market. So let's take a look at resistance now, and Tyrone will go through that with us.
So resistance works basically the same way as support does, except that it's overhead. So if we're looking at a trend moving up, we're looking at the first point of resistance as being the first place that we would either take profit on a long position or potentially profit from selling off that resistance zone. So resistance can come in many forms. It can be a previous support level that has been turned into resistance, or it could be a new all-time high. There are a few different ways that we can look at it. Also, resistance can be a psychological level or a double zero level, we like to call it. So in the currency pairs, we would consider, say, a 77 US dollar Aussie as a psychological level, or even parity, one of the biggest double or triple zeros of them all. So you'll find when currencies do move to a parity position, there will be support or resistance very heavily placed at those particular levels. So we can see here again, we've got 3 touches here on the example, but really all we need is 2 solid touches to begin with, and on the 3rd touch we can safely say that a resistance level is established. So on the 3rd touch here, we do have a few options. We could basically look for selling off the position if we're not in a long hold from there. If this is our fresh position, we would consider selling it there, with the potential of maybe this trend reversing, or of course it coming up and touching the resistance level again.
So here we can see that price has come up and has touched the 4th point, and we would look at basically selling off the market or selling this pair down and profiting from the decrease in price. So these are just a couple of quick technical examples, but let's have a look at some examples of support and resistance in the real markets. So here we have the Australian Japanese yen, and this is a daily chart, and the reason why we may use a daily chart is because more people will see a daily chart compared to something like a 15-minute chart, where a little bit less people will see it. I always like to ask the question, or you need to ask the question of yourself, is how many people will see the trade that I'm looking at? Because the more significant the time frame, or the bigger the time frame, the more people that are going to see that trade and potentially trade with you. And you always need to think of it from a perspective of who's investing in the market, and we've got the hedge fund traders, the banks, the big financial institutions, and they are going to trade the larger timeframes with more significant money. So here we have the daily example. We can see that we've got point A, where the market has come up, come back down with a retracement, found some form of buying or support level. It's gone back up, and then it's come back down and touched the same point at point B. So there's basically 1 touch here and 2 touches here. Now, after we see something like this in the market, on the 3rd touch, as Tyrone said, it's very significant because it basically is telling us that twice there's been buying pressure here, so there should be buying pressure again at this point. We could see there was buying pressure where we could basically profit from the buying at the Australian versus the Japanese yen, and at D, the same thing happened, and then it continued in the uptrend.
Okay, so I think it's very important that we're aware of support, not just for reasons of buying, but also if we were considering a short position, above this support level, if we didn't take notice of the support underneath us, we'd be basically heading into a very strong headwind without potentially knowing it. So even just for the point of knowing where support and resistance is, even if you're not going to trade it, it's very beneficial to know that it's actually not right in front of the direction that you're trying to go. So we can see here A, B, and C and D clearly held every time. And again, because we are on a daily chart, we can consider this support very, very strong. Now, if we took this out to a weekly or a monthly chart, you'll probably find that this key level, because it's so strong here, has been a key level in the past. So it's always good to go back into a couple of the bigger time frames and just see if you can identify support at previous levels to see if we can strengthen what we're seeing here.
Now, we'll be taking a look at that in some live examples soon, where we break down the larger timeframes to the smaller timeframes and look for the supports on each timeframe through. So here's another example just quickly of resistance. You can very clearly see that this is a very good psychological level or resistance level in the market. The other thing that's really great about this is that it looks like it's a very high or outlying point. So whenever you're looking for significant factors in resistance or support, we want to be looking for points where the market has only reached that point maybe once and it becomes clearer for us to see. So this is the Australian US dollar daily chart. You can see we've got a touch at A, a touch at B, a touch at C, D, and E, and it's found resistance multiple times.
So for those who aren't aware, when the Aussie dollar did get up here to around the 105 level, it seems like a very long time ago now, but it was quite a few years ago. But this was uncharted territory for the Australian dollar, and many thought that it was actually going to break through and potentially go to 120, which in hindsight seems a little bit ridiculous. But
it was a prediction at the point.
It was a prediction at the point, but as you can see, when a market is hitting an absolute all-time high or very, very key levels, you can see how strong the resistance is. And quite often, if you look at point A, it tested it there for basically a week with 5 candles testing it. But when we go to point B, the rejection from there was very, very strong. That basically, it's a very large rejection candle. C and D certainly tested it basically for a week and nearly 2 weeks over at D. But the sell-offs are fairly significant. So again, the bigger the time frame that we're looking at the resistance and the more key the zone, because as we said, this is also a psychological zone because it's a new test of an area, the rejection is usually going to be fairly solid. So if we look at how far this Aussie dollar fell when it did reject off D, we're talking about levels closer to the 101. So we're talking 400 or 500 pips nearly on the sell-off, and it's happened 3 or 4 times.
You'll also notice there's a form of support down here. We've got multiple touches to this point. So sometimes these occur, and we'll talk about a pattern that happens with support and resistance a little bit later. So a couple of things just to note is basically how do we figure out the strength of the support resistance level? And there's a few factors that are there, and we'll just leave this up for a second. But basically, it's the more times the level has been respected, generally the stronger it is. So the more touches we see, the stronger that point is. A recent level will generally have greater significance over an older level. So always use common sense with this. If we're trading an hour chart, we don't want to be going back years to find support resistance levels that are relevant to that hour chart. If it's a daily, obviously, we wouldn't want to be looking back too far either. So we'd always want to be going for the time frame and then going back maybe to 2 time frames above that and what we can see in the screen or in our viewing window. We also have a level that's formed around a psychological number. So as Tyrone said before, if we have a number like parity, it's always important. So if we see the Australian US dollar at 1 directly, that is going to be a form of probably a support or resistance level, at least the first time. And if the point is at an extreme high or low, so similar to when the Australian dollar was at that 105, it was a very extreme level, just like when the Australian dollar was in the 40s many years ago, that was a very extreme level.
Absolutely, they're certainly the outliers. And when we're talking about what we're seeing in regards to currency, the psychological levels and the round number levels are also moved on to things like indexes and CFDs if you're trading stocks. So the round numbers work basically in all instruments. So psychological levels cover nearly every instrument that we can trade.
So let's take a quick look at some live examples in the market now. So I just want to start with the Australian US dollar. I'm sure a few people probably trade that out there. And we can see here that I've got a weekly time frame up. So generally I like to start in the weekly or monthly, which is a little bit unusual for a lot of traders, as I know a lot of people probably like to scalp and trade those 15-minute 1 hours. But the reason I do this is because I want to see the overall support resistance levels. So couple of things I do before I move down to the other levels is I'll always move to a line chart first. And the reason why is when you're doing support and resistance analysis, line charts are often a little bit clearer for you to figure out the good and clear levels that have been touched multiple times. So we can see here that we've got a clear level of support where we've got 1 touch and 2 touches down here. And we've also got some clear level of resistance where we've got multiple touches to this high side on the Australian dollar. So we'll put 2 lines in here and we'll adjust them as we go down through the time frames. Now, if we just go back to the candle for a second, it looks kind of clear now, but it may not always look as clear. So moving to the line chart or the close price usually smooths out these charts quite significantly.
It does remove a lot of the noise when you take the line charts because it basically plots on the close price of each candle or each period. So it does remove a lot of the daily noise.
What we'll do then is generally I like to go down to the next time frame and I'll pull the support and resistance levels to the close points on the chart. So you can see here that with the Australian dollar, it often has touched this point here, and these are where the peaks are. So that's a very clear level of resistance. And if the market was to come up to this point over the next couple of weeks, we would expect this to be a resistance point in the market. Very, very clear one. The other thing we want to do is we bring down our support. We can see here that this is where it found support twice. So very, very clear levels of resistance and support on the Australian dollar. And when something is trading within a level like this, it's basically range bound. So there's no clear direction on the longer time frames on the Australian dollar. It's stuck between these 2 points. And I'll just get those points because probably a few people will ask. So this is 77.50, and down here it's 71, 60, 50 area. So you'll notice they've also gravitated to kind of the 50s or the double zeros, which often we see in the markets.
So with those numbers alone, you'll probably start to realize that you've got a lot of trading opportunities inside this, basically what is formed as a channel. We've got a support and resistance line. So the opportunities when we're going short, we've got a very clear target, and obviously when we're going long, we know where our target is, because if we weren't treating that resistance with a lot of caution in taking profits or potentially wanting to sell off there, it would be basically remiss of our trading analysis, because we can see clearly that it's been holding for, coming on probably 2 years, I believe. We take that out.
Yeah, so this started last year in 2000.
It started last year, and even before then, you can see that when price came down and actually broke it, it was actually there. It hung around there for the best part of 6 months before it actually finally broke down. So it is a serious level of resistance there. So we know that if price pushes up a little bit further from here, a very logical target is about 150 pips away, straight up into that resistance.
Yeah, and we should see price probably gravitate to this point over the next couple of weeks. And it's our job as technical traders to figure out opportunities in the hour, 4 hour, 15-minute charts where we can take advantage of this and obviously look for smaller technical reasons to be in the trades. So next up, I'd like to just take a quick look at the US dollar yen. So here we've got the US dollar yen. Again, I'd just like to go over to a line chart. So here we have the line chart, and very clearly we can see that we've got a support line down here with the 2 touches, and we also have a resistance point here and potentially 2 touches to this zone. So this may be an opportunity for what we call roll reversal or some form of roll reversal trade. So let's have a look. Yes, there was a few touches here. We had a touch here. It broke through, found resistance at this point, came down to this point, found resistance at this point, and then came down to this point again. So let's jump back into the slides and learn a little bit about roll reversal and how we can use that with support resistance to trade the markets.
Okay, so with the roll reversal, what we're basically seeing here in the example is what was a resistance zone first eventually breaks through. So that's the thing. Support and resistance is resistance or support only until it eventually breaks. But what we often see, when a serious resistance zone is broken, it often comes down and retests that level from the upside. So we consider that obviously a roll reversal, because now what was resistance is now support. And quite often, these levels of support after a resistance level has struggled to break through is often quite strong, well, even more strong than the normal support that you would see if the price was getting there for the first time. It's almost like the traders at the first time couldn't break through that zone, but when it eventually did, it just provides extra support. So it's a great place to, if we're going along at this support zone here, every time it does touch it, our take profits don't have to be very far away, because we know we've got the resistance zone protecting it down the bottom. So if this was a standard double bottom that we were trading that didn't have this sort of level of support that was once resistance, we would have to be a little bit more careful with where we're putting our stop losses, primarily because there is no real wall there to protect us. So it's almost like an extra layer of protection.
The other thing about roll reversal, or where resistance becomes support here, is we've got to ask ourselves the question is, are we trading with trend whenever we're looking at a market position? So obviously a lot of people have heard of the common conception of trend is your friend, and it's definitely a thing. So when you're trading with trend, you've asked yourself the question is, why is that currency trending? Generally that currency is trending due to a fundamental change or a fundamental reason, as trying to find fair value. So we've seen a trend break, we've seen a continuation of that trend, and when we find a point like roll reversal, what we're doing is we're picking up the market where it's gone from resistance to support and a continuation of that trend. And generally you'll find your percentages or your winning trades will be more significant when you are following the trend or the fundamentals, because they are driven by huge market forces. And who are trading those? The banks, the hedge funds, the large traders, and they're the ones that move the market. So what we want to be doing is going with that flow, and roll reversal allows us to do that.
What a lot of people don't realize about roll reversal is it is actually a healthy part of the trend, because what we're looking for in a strong trending market that's actually healthy is basically a 2 steps forward, 1 step back approach, where the market moves 2 levels forward and then comes back and tests it. So when we see a support loan being broken by a strong trend, it is actually very healthy for that trend to actually come back and retest that zone, as it treats that as a launching pad for the next big wave up.
So here we have an example of basically the opposite role reversal, where support is broken and then that support becomes resistance. Now, we don't always need to see 2 touches to this point. Generally, we'll actually just see 1, where the market will break through a support, maybe 2, 3, 4, 5 touches, but at some point it does break through. And then when it comes back, it tests that point, and the more significant that support or the more touches are there, the more people are going to probably be looking for the role reversal. So when it does come back, they're going to clearly see that was support and therefore clearly be able to trade it. So it really is about the significance of this particular support or resistance. How many times has it been touched? How many people are seeing it? How clear is it to you? And like any technical trading method, if it's clear to you, then other people are probably seeing that as well and trading it. And that's what we really want to be doing.
The thing with role reversal is it's almost an opportunity to re-enter a trade that you may well have missed had you missed a support break in the first place. So the conservative entry on a break of this support line, if we were in a downtrend, would be to wait for that resistance zone to be retouched. It doesn't always happen, and sometimes market forces just completely break support and it just does not come back. But the aggressive entry is definitely on the close of a candle below the support line on a significant time frame. But if we do miss that, which quite often does happen at a time when we could be in bed during the London or the New York markets, especially for us Australian traders, we do miss a lot of the big moves due to the news that happens overnight. We do sometimes get that retrace, and I often consider the retrace a better trade than the initial break anyway, because it is very healthy for the downtrend market to come and retest this level.
The other thing that's good is if we recognize a level like this, so let's say this is the close when we go into bed, whatever time, it's 11 p.m, we want to go to bed. We've seen that point, we've gone, oh damn, we missed it. But what we can do is we can set up a pending order in the market where we can take advantage of the role reversal scenario. So let's say we recognize this is a resistance level, obviously 4 touches over here, pretty strong resistance. We'd expect the market to be probably rising here, so this would be an uptrend. And when it does break, and we see it here, we put a pending order in this zone over here, we put a buy, and of course we can go to sleep, and if that level's hit, then that's excellent. If it isn't, well, we've missed it. So that is definitely something that we'd be wanting to look at, and then of course, hopefully it continues on in the level, in the, I guess, the direction of the trend.
Just touching on what we talked about earlier in regards to how support and resistance works, this is a really good example on how the support that is formed because of a previous resistance zone is really isolating these candles. If we look here on all of the candle touches, the first time it touched it, yes, we spent a little bit of a period down. This is a 4-hour chart, so we spent maybe a day and a half at that level. But once it did lift off there from then on, every 4-hour candle basically rejected in that 4-hour period. Just testament to how strong that level was. We had 5 or 6 very serious rejections from that level. And when it did eventually break, it was just not coming back. So yeah, definitely the resistance certainly helped that support hold there, where it otherwise may have tested it and it meandered there a little bit.
Yeah, and those wicks really signify the strength of the buying support here. So let's take a look at a live example again. We're going to go back to that US dollar yen, because I think it's a good example of what we're seeing in the market right now, where we've seen some support, resistance, and potentially a role reversal pattern. So we'll go back over here and we'll look at our previous support line with our support over here that became resistance. So we had a couple of trade opportunities here. We've got the support. When it breaks and it comes back and retests, we could potentially look at shorting here or selling down the US dollar yen. And whenever we were looking at something like this type of trade, we really need to be looking at 2 things. 1, where can we expect to take profit? And 2, where can we expect to have our stop loss in the safest point? So in this case, where our stop loss would need to be is it would need to be behind the last swing. So above here actually would be our stop loss. But from our take profit perspective, it would just be at the last low. So we'd be basically looking at some form of 1-to-1 trade, or if we were risking $100, we'd be probably only making $100. Now that's not always the way, but in this case, that's what we'd be looking at. There is another trade that happens here though, And I'm not sure if many people probably won't be covering it today, but it's basically what they call a double bottom pattern. So if you look that up on the internet, or we might be covering it over the next couple of weeks, you can come back and see the technical theory behind it. So what this is basically where a support line has been formed, where we've got two touches, and we've got what we call an intervening trough, or a point in the middle between that market, where if that broke, we could consider a buy and the end of a downtrend and the start of potentially an uptrend. So what we see here is the market broke it very strongly, and we may not have been here for this opportunity, and we may have realized up here, we went, oh, that's a double bottom, wish we got in that trade. Well, by using role reversal, or the theory of role reversal, we can basically pick that trade back up with a pending order, and you'll notice it came right back down, tested this point, and then the buyers came in and pushed the market higher to the next resistance area. So
I think the point of what we're trying to say here with the support and resistance role reversal is not to be afraid of actually re-entering after the initial break, because I know a lot of people feel that, well, they've missed the initial break and now it's coming back, it's going to fail again. The statistics usually go with the fact that once it does come back and retest this zone, the next launch up will break the previous break. So never be afraid to take that entry point if indeed that's where you were heading in the first place, because all it is just a natural movement of the market trend, and it is very healthy for a trend to actually do that. A trend that goes up and doesn't come back for a retest is usually a trend that's not going to continue. So just bear that in mind when we do see a break, because it is very, very clear that a lot of the times these breaks do happen at a time when we're not going to be in front of the charts.
A couple of nice other things you see with double bottoms is you can generally go for some kind of, I guess, idea of where the market should go. So with a double bottom, again, we'll just go to the line chart quickly, see those touches. We usually take the distance of between the two bottoms and that intervening trough, and we take that distance, and that's our expectation. And like anything with the market, is that's our expectation, but we should always set our, I guess, like our opportunity or where we want to set our take profit is a little bit less than that. So around 80% of what we expect is generally where the market will stop, and that's just because many people in the market will take their profits early. So, and that happens with the bigger traders as well.
So just with double bottoms, I know we're not going to focus them on too much, but because this is such a good example, I just want to just touch quickly on this particular one for those who are not familiar with this pattern. We can see here on the first touch, on the first bottom, when we go to a line chart, it's probably a little bit less clear, but on a candle chart, we can see this is what we call an Eve Adam double bottom. So the first touch is an Eve, which is what we refer to as a bottom that's got about 5 or 6 touches, as opposed to an Adam. We consider Adam a scrawny sort of tall fella. And you can see that it rejected quite heavily off that. So when we see a double bottom that is quite wide at the first touch, but then rejects fairly sharply on the second touch, it usually bodes well for the success of that pattern. So we do like to see this big move up from the second touch, because that's showing very aggressive buyer behavior at that touch again. And they're the ones that are most likely to actually break up and continue on with the job.
Yeah, so this is the big candle here that Tyron's talking about. That strength, followed by the next couple of candles worth of strength, really shows to us or signifies us a trend change in the market and a buyer change. So we've got the sellers have basically lost control of the market, and the buyers have gained control of the market.
A lot of people consider technical analysis as a bit of an after the fact sort of thing, but we really, when we look at this, we're looking at a currency pair here being the USD yen, which hasn't been the cleanest in recent time. It's had a lot of turmoil with economic news all around the world, and it's been very, very messy, to be truthful. But I mean, I look at it and I see lines and zones everywhere. So this is not even a very good trending pair at the moment that you can say you can trade with any confidence. But when we look at these lines, and they're all all there for us to see, our zones and our expectations of every trade that we take are very, very clear. So yeah, imagine when we do get a very nice trending pair, how the opportunities will open up for us.
So let's just take a look now at the euro. It's probably another good example of where we've got a market that's finding kind of like a consolidatory area. So you can see here the euro has been rising over the last couple of weeks. It's been going up. It's in, I guess you could say, a daily bull market. If we go down to like the 4-hour time frames, from that we will see a kind of point here where the market is finding some form of potential support. So we don't necessarily want to get involved in a market like this right now, but what we do also notice, and we'll go down to a smaller time frame again, the hour, is that this could potentially be a trading opportunity for us moving forward. So we might not buy it now, but we can see here bottom, we can see here a trough or intervening trough, and we can see here another bottom. So it is, again, something similar to a double bottom pattern. What we might do is we might just grab some MACD, which is an indicator you can put on. And one thing that, again, we'll cover in the next couple of weeks is a thing called divergence. And if we did see the point break here, we would expect for it to be a confirmed double bottom and for price to potentially rise after it's tested here. And like what we learned with role reversal, if that did happen and the market was to go up, we probably would expect that the market would therefore come down and maybe test this point.
The problem with a lot of double bottom trading, a lot of people seem to think that they're not a very successful pattern, is because many people actually trade them wrong. So a lot of people would see this as potential double bottom and jump right in and trade it here to the break, when in actual fact what we're looking for to actually trade this double bottom in the correct format, we're actually looking for it to break the neckline, which we saw earlier. If we can just pop that up there. So it needs to move, you know, another, well, basically, where's that level there? So this,
I'll zoom that in for you.
Yep, great. So basically, we need to see this move another, you know,
50 pips.
50 solid pips before we can even consider this a double bottom. So if anybody's looking at potentially trading this pattern as a double bottom, you can't actually get in for at least another 50 or 60 pips, and any trade prior to that is not trading a double bottom. So that's why they can get a little bit of a bad rap sometimes, but when they're traded properly, especially when in a situation like this where the take profit, if it does break, is very, very clear because it's a resistance zone from above, the chances of success are usually pretty good. So what the MACD divergence is telling us down here is that there is potential for this double bottom to play out as we would like it, but it's still got a little bit of work to do.
It's just an example, I guess, of where you can draw up your support, you can draw a resistance, and then you can make some trades with that. So the essence is, if you are able to draw really strong support resistance levels, use those line charts to really simplify what you're seeing on the charts, you can find quite a lot of patterns. And if you're confident and patient, and really patience is the key, you'll be able to get some success with these trades. Now, a few people are probably going to ask whether support resistance works on all time frames. Yes, it does. I would generally stick to a 15-minute or higher time frame when drawing up my support resistance, but hour, 4 hour seem to be very good, and same with daily. Let's just jump back into the slides quickly, and we're going to have a look at another theory or pattern, and that is channel patterns. So like the double bottom, like the role reversal, channel patterns are another thing that we can do or draw in the market that's based on strong support and strong resistance. So here we have a market which is basically range bound. We've got multiple touches to each point, and we can see here we've got a strong level of resistance and a strong level of support. So we've got the first touch, the second touch, and then it becomes valid. So when we're looking at channels or any type of pattern strategy, we always want to look at something where we've got clear rules. Now with a channel pattern, it's always about the two touches. So until you see two touches, so the first touch of each side and the second touch of each side, it will not be a valid technical channel, and therefore we shouldn't be technically trading it like one.
So channels are basically made up as what we've been talking about, a support and resistance line that are running obviously parallel with each other, but are having similar touches on the top side and the bottom side. The example we saw earlier on the Aussie, as you saw, was nearly a 5 or 6 cent range. So what that provides us is ample opportunities to trade both short and long inside that channel on the smaller time frames. What we need to be aware of, especially given the time frame that the channel is forming, is to how much of a move we can expect. So if we're getting a pattern forming somewhere in the middle of that channel on a 1 hour chart, and we know we've got a daily channel that's got 200 pips on each side, we've got a relatively good chance of success because many shorter term trends can actually form inside those channels. And how long a channel lasts is, again, it's basically subject to how long price will stay there. There's no set rule as to how many times it can touch the top side or the bottom side. In fact, some of the best channels can last, a year and a half, 2 years on some of the bigger time frames, which provides us with ample opportunities to make money on the upside and the downside in that price.
And channels will form on, again, all time frames. So you'll see channels within channels. We'll take a look at the Australian dollar because that is definitely a channel right now. But how we trade these is effectively if they come to the top or they come to the resistance side, we're going to look to sell the market or sell at this point, and we're going to place our stop somewhere above the last wicks or the last highs that we see. And we'll take a look at the live example soon for this. If it comes down to the bottom, we're going to look at buying the market and basically profiting from the increase in price, and we'll continue to do this until the channel breaks either side. So it's really trapping price, and it's how we easily recognize a market that's no longer trending. So if you've ever, used a moving average crossover or some other type of indicator and you're reliant on trend in those kind of strategies, by just learning how a channel strategy works and by using the two-touch validation technique, then we can correctly identify when the market stopped trending and the market's become a range-bound or channel-based market. And that will allow us to, take advantage of not getting stuck in non-trending markets when we're using trending indicators.
The great thing about channels also, as support and resistance forms, is that it gives us very, very clear rules to follow. And part of trading, and I guess it's one of the biggest misconceptions there is, that you don't need rules to actually trade. You should just go on your gut instinct. But nothing could be actually further from the truth. To be a successful professional trader, you need rules to actually follow and make sure that you abide by to ensure your chances of success. And what channels give us are very, very clear-cut rules on not only the entry, but also the exits.
So we'll just have a quick look at channel strategy breaks before we go into the live example. Basically, if a channel does break and you see a break to the upside, what you're going to want to be doing is actually then taking the other side. So when a channel breaks, it usually happens due to a fundamental reason or something happening in the market. Recently, we saw a pound breakout because of the big pound news. So we see this buy, or we see this opportunity where the market's broken to the upside. We want to get involved in this, and obviously we would like to buy the market. The great thing about any pattern is what we do is we basically take the distance of the channel and then we use that for our take profit zone. So whatever the distance of the channel was, that should be our take profit. And you can see here that the conservative stop loss, or one option for a stop loss, would be to place our stops below the lows of the channel. That is only one way. There is also a more aggressive way where you look for the last kind of swing or maybe roll reversal area inside this particular upswing, and we put our stop loss in that point.
So the conservative way to trade the channel break would be, of course, to wait for the retrace of the roll reversal. And then that gives us two advantages. One, we're getting to see what price is actually doing while it does it. But also, it also gives us the opportunity to actually have our stop loss a fair bit closer than the initial aggressive break. So what we're seeing here, if we took this initial aggressive break of this line, we're going to have a stop loss that's nearly the whole distance of the channel. But if we waited for the roll reversal, when it comes back down and tests that resistance zone, which has now become support, all we have to do is put the stop loss behind the last swing high, and that will basically take care of any price movement, because we can expect that resistance will provide the extra support that we need to make sure that price doesn't get back down there and stop us out.
All right, let's take a quick look at the live examples again. I just want to go back over the Australian dollar. So we can see that this particular channel has validated because we've got a single touch up here, a touch down here, a second touch, and a second touch. So every time the market comes up to this point or comes down to this point, we want to basically sell and buy this market and take profit somewhere in between. Usually we'd like to take it around 80% of the move back. The other thing that we can look at doing is, of course, if the Australian dollar was to break higher past this point or break lower past this point, we could actually take this entire distance and that would be our projection. Now, a lot of people will say, wow, that's a pretty big projection, but these are the type of things that happen in the market over and over again. So you can see over here, we've had, and we'll just go back actually just a quick little bit of time. This is that example that we had before where we had that Australian dollar stuck within a point in a zone, and it stuck there for quite a long period of time. So it validated over here, and then every time it came up to the top, we could look at selling it, and every time it came down to the bottom, we could look at buying it. And of course, when it did break, we'd definitely be looking at selling this market and profiting from the decrease in price.
Like, that's a very good example of what we can see there. Like, that's nearly a year's worth of trading that was stuck in that channel. So that's why there's just no rules as to how long a channel can last. But the opportunities that gave us to trade inside that channel were just phenomenal. I wish you could do it again.
Yeah, but, this is a very good time.
Yeah. And what seems like a very large gap of nearly 400 pips seems almost ridiculous that it could actually, its projection would be 400 pips. But as we can see, it's basically moved down nearly 40 cents from that level, let alone 40 pips. So
yeah, well, this channel break really did happen for a fundamental reason. So fundamentals played a part here, but also when we see these breaks, generally when you look at the kind of idea of where it should go, the market will often give you kind of like a hint of that's where it should have stopped. So you can see here the support and the multiple support touches that happened here, and then when it did break down, we'll also notice that role reversal. So we'll notice the support has become resistance, and that gave us an opportunity as well. So these things become very clear to us, and they're also a great thing for us to see because it gives us the confidence in our trading. And I think a lot of people will agree, you've probably had a trading strategy where it just hasn't worked out a couple of times, then you've said, oh, that trading strategy doesn't work for me, and you've basically put that aside and gone on to the next one. And sometimes that can be the worst thing that you can do. So you need to get that confidence in your trading. And by using support resistance, role reversal, channel patterns, these kind of things, it really gives you the confidence of trading.
And you absolutely need to trust in the technicals that you're looking at. If you do sound technical analysis in your trading, you'll find that even in this example here, if we look closely where this did break, we can see a double bottom. Oops, we can see this double bottom that's just formed right there, and as we can see, the target for that double bottom is going very, very close to the role reversal resistance. So we could have identified that level as a potential target. So if we draw our line there, it's very clear that that any form of resistance was not going to actually interfere with what the pattern was going to play out at. Yes, it went a fair bit further, and that's quite often what happens in patterns, but that's not what we're trying to do. We're not trying to pick the absolute top or bottom. We're just following the rules of what the patterns are telling us. So when you have faith in your analysis and you can see clear patterns like that, they just seem to work out like poetry.
The other thing is we'll see the market did literally respect this level. This was the expectation of what a double bottom should have done. The market did come up. It took profit here. Obviously, it went on, got the role reversal area on the larger time frame, but this definitely was a point where people took the profit. So when we see these patterns, we see them work out. Obviously, it's easy to see in hindsight, but you can see it at the same time and in the live markets. Because
just like the euro is at the moment, it's certainly a potential setup that we'll certainly be watching.
Yeah, we'll go back to that just for a second here. So we'll see if it doesn't break to the low, it may do so. We don't really care what it does right now. What we want to do is we want to look for potential setups, and if that setup does happen, we'll get involved with that kind of setup because that's the technical way of trading it.
And again, as we can see, the first point of serious resistance is going to be the exact place that we would be looking at taking profit on that double bottom, which is, if we move that up, straight into, there we go. So that's our distance of the double bottom. We take the profit there, and lo and behold, it's exactly where the resistance would be from the previous channel. So it makes it very, very easy to set your rules up and follow them.
Definitely does. All right, I just, before we get into a couple of questions, I just thought I'd go over very briefly a couple of other charts. I wanted to really just have a quick look at the pound yen. The reason why I wanted to look at the pound yen is you'll often find that I know a lot of people trade all of the yen pairs, myself included. It's something where when you follow the major or the US dollar yen, often you'll see a technical pattern, and that technical pattern will play out on the smaller time or the other currency pairs as well. So here we have the pound yen. It's not quite a double bottom, but it is definitely something where there's founding support here. There was previous support, resistance, a break of that resistance, and then maybe a retest to this point. So this could also potentially be somewhere where we'd like to get involved with the market. We've seen the previous support, we've seen the previous resistance, and this could be a role reversal point. It's not super strong, but it's definitely something that we can look at. And that is very similar to the US dollar yen, which has done a very similar pattern And then, of course, in this case, the US dollar is a little bit stronger than the pound. Same patterns, same things. You check each currency pair, you have a look at each one. If they're doing the same things, you can definitely get involved as well.
And if this yen actually did break up above this level, where would you think the expected take profit would be, Thomas? Could you please tell everybody?
So if it broke past here?
Yeah. Just so everybody can see that even we've got a plan for whatever the market does.
Oh, just wanted to quickly look at this. So here we've got our point here. And of course, when it breaks past here, we'd expect the market to go back into this point, probably around just here. And the reason why we do that is because we've got our previous supports, we've got our resistances, and when it breaks, we look for the next strong level of resistance or support. And this is where the next strong level is.
At the very, very least, you would be breaking even your trade or taking a potential, some profit off the table at that point, because we know that it's going to reverse at some point from there. How far it reverses, we don't know, but that's your first place of serious resistance. So you'll be definitely taking some of your profits or taking evasive action to protect any of your profits at that level.
Great. So what I'll do is I'll just quickly jump back into the slides before we get into the question time. Just want to talk about economic news really quickly. I'll bring this up just so everyone can see it. These are the kind of things that we look for in the economic news. The main fundamental, I guess, reasons that things do happen and things break into trends. So I'll just leave that up, and I guess we'll answer a couple of questions if Fabian's around.
Yeah, hi guys. Got a few questions here. So starting off with initial breakouts and support and resistance, how would you deal with a small breakout of a strong line, when a support is tested or resistance is tested, when you have a long candle wick or something that appears to break out? How do you judge if it's actually broken out or if it's just a fake out?
Okay, that's a really good question. Let's take a look at an example over here. So where you want to really be doing, I guess, most of your analysis is when you've figured out where your support resistance is, look for the time frame that's going to be most relevant and it's clearest. When we find the most relevant and clear time frame for that support resistance, then what we want to do is we want to see how the previous support points have broken and whether they've been confirmed or not. So say this example here, we see this support on the 4 hour actually wicked back and did not break. Now, if we look at an hour chart for this particular time frame, it's going to present a very different picture where the market has broken through on that hour. So what we wouldn't be doing is we would not be using an hour time frame to confirm this break of support. We'd be more likely to use a 4 hour. And in this case, when the 4 hour did break through here, you can see it's closed, and it's closed as the body of the candle. One thing we never want to do as a trader is we never want to preempt what the market's telling us. When a candle is formed and closed, that candle is set in stone, or it's set at that level. It's not going to ever change, and it's set in history for us to look back over it. If the candle has wicked over here, we can see that clearly, whereas over here, it's definitely closed below. So we always want to look for the close of the market or the close of the most relevant time frame.
We always have to be very mindful that, as always with any pattern and any confirmed break, the bigger the candle or the bigger the time frame of that candle, the more significant. So if we're looking at a 4 hour as a minimum would be the only the lowest I would go to actually use as a break of a support or resistance level. Really, an hour or a 15-minute is just, there's way too much noise in that. And if the more time frames you took that back to, the more candles have actually broken through it. But all that's giving us is, well, you can call it a fake out if you like, but we just call it noise. Like, we wouldn't even consider trading that. But a close of a daily candle, or even more significantly a weekly candle, we've got to remember that a weekly candle represents the buying and selling dynamics of a whole week's range of 3 major markets of the world. We've got the Asian market, the European and London markets, and also the New York markets trading for an entire week. So for that candle to actually close above a support or resistance zone is a very significant signal that it could be potentially breaking or about to break.
So I guess to answer it, confirmation is key. Every time.
And the bigger the time frame, the bigger the pay.
Yep.
Awesome, thanks guys. Now, you also mentioned before, obviously Aussies tend to miss out on all the action with the London session and the US session, sorry. Would it be a good idea to use potentially pending orders to trade those if you see a role reversal happening, potentially set a pending order to take advantage of that, or should you sort of wait and see what happens?
Yeah, really good question. We'll use this example, I guess, as a classic. So when this broke, it may have been, I'm not sure exactly what time it was, but when this broke, we may not have been awake or involved in this. So we could always set an alert, like an email alert or a text alert or something, to say when this point broke, because we might have recognized this as a potential double bottom at this point. And then when we go to bed, or when we can't, wait any longer, or we've missed the trade, we can put that pending order in here. In this case, we'd be using a buy limit order. We place the buy limit here, and we'd be looking, of course, at picking that up sometime through the night. And if that happened, that'd be great. But as Aussies, or in someone in this trading session, we don't always get the best opportunities. So pending orders definitely are key.
So if you're like myself and are married or have a partner, emails and text alerts in the middle of the night are certainly not going to be conducive to a happy relationship. So when you are setting pending orders in these types of, I guess, trades, what you have to be mindful of is that if your pending order is anticipating the break of a zone, you're not going to have any control as to whether that candle actually confirms that it's broken it. So I would highly suggest that if you're not using email alerts or text message alerts, only set pending orders once it's been broken and you're actually buying the retrace. So don't ever set a pending order anticipating a potential break through the night, because you're not going to get confirmation. It could certainly wick through it, like you can see in many opportunities here, like even at the break of that candle in the middle, the first touch just there. So you can see that had we had a pending order there, we didn't get a close confirmation of that line, but we would have been entered had we placed a pending order long to break that channel. Whereas on the retrace, once it has officially broken and we're waiting to re-enter on the retrace of that support, which was once resistance, we can be very confident that that level is going to be held. In fact, we actually want it to come back because we want to enter the market. So pending orders in isolation depend on whether you're actually buying after the break of the confirmed break, or if you are anticipating a break, just be very mindful that you're better off being there and making sure that that candle has actually confirmed that the close is above that level.
Thanks, guys. And just in relation to that as well, when you're placing a stop loss, if you're ever using those pending orders, would you place it directly below the support or directly above the resistance, or should you leave yourself a gap depending on the time frame?
Okay, so the time frame, it's a good question. So stop losses are obviously very important. The one thing about stop losses is we can't control what the market's actually going to do once our trade is placed. The only control we do have is how much we stand to lose on a trade. So when we're placing stop losses, especially with pending orders, what we're looking for is at least a low below the last swing. So in this example here, we can see that this move has been very aggressive. So we've moved from the bottom of this double bottom, because it's an atom double bottom, it's effectively moved the whole length of that channel in 5 candles. So in this particular instance, our stop loss would actually be quite large if we were trading it with the correct levels, because it has to be at the bottom of that atom bottom. Normally, we don't actually see a move that's so aggressive that it doesn't actually swing back. So the swing back on this particular trade has actually happened above where it's actually broken the channel. So as far as examples go, this is a terrible one of where we would actually put a reasonable stop loss. It's actually giving us a very long stop loss. But if we look at I've just drawn kind of example of what we would generally see. This is what we would generally see. But again, because the USD yen is quite an aggressively messy pair at the moment, and it's not always like this. For the most part, the USD yen is actually a very pleasant thing to trade. This was a very aggressive move, so the stop loss, unfortunately, on this trade would have to be quite significant, and it would actually be below the double bottom there. So if we were placing this like a pending order, obviously we could go in here. We would basically set up pending order, buy limit, put in our price. So in this case, we missed it, let's say. We might say, okay, 110.60
75. So we put in 110.75. We place in our stop loss. If we saw something like this, our stop loss would be somewhere at, say 109.92. I'll just put it in for example. And then of course we'd set our take profit at wherever that is. And then we put that contract size in, and we could see how that appeared on the charts. We can then go to sleep, wake up in the morning. If we're hit, we're hit. If we're not, we're not. And then we assess the market after that point.
When the stop loss is too large in a situation like this, quite often the best place to actually place your stop loss, if you don't want it to have it too far back, is actually after the last swing. So if we look at this area here, we'd basically put it under, basically just below the middle zone there, underneath the last swing back, because we would pretty reasonably expect that that would actually hold if price indeed came down there. Normally after an aggressive break like this, I probably wouldn't expect price would come all the way back there, but we always have to have a stop loss in place anyway. So we would go back to the previous swing and actually use that as our determinant for our stop loss.
Any others, Fab?
Thanks, guys. Yeah, and just to quickly mention as well, obviously Pepperstone's smart trader tools, you can use the alarm manager there to get a few different alerts along those, so you can keep yourself aware of the price movements, even if you're not confident in placing a stop loss as well. So one other question we have in regards to taking an order around fundamental events. So obviously there's always big news events coming up. Would a fundamental event like an interest rate decision or employment data take precedence over a strong technical pattern, or so do you see one cancelling each other out?
Okay, yeah, it's a one that's very, very common questions asked. Generally, what you're actually going to see is a strong fundamental event will often happen with some form of technical level. So if we have a look at the Australian dollar, just for example here, and we've got that level of resistance and support. If we were having, let's say, a large interest rate decision or something like that, you may see that price will gravitate up to either the resistance or the support level. So price will actually get close to there, and then it will wait for that fundamental news, and it will make a decision. Obviously, whatever the news is, the market will make a decision, and it may break either way. So what I like to do is I actually like to wait for the fundamental news to come out, and let's say it did break past here and go further. What we'd be then saying is maybe we could get involved in the market because that's a break of our channel, or we could look for the more conservative entry. So if price went up, we'd be obviously looking for the price to come back down and do that role reversal area. So that's the way that I would trade fundamentals.
Generally, you'll find that the fundamentals, especially the bigger decisions like interest rate decisions and non-farm payrolls, affect technical levels on the smaller time frames. You'll find that the daily and the weekly time frames, those sorts of levels tend to hold up because it takes away the noise. Most of the time, it uses noise.
You'll actually benefit from the fundamental decisions because you may already be in the market, and because you're trading with the larger time frames, often the fundamentals continue in the direction that you're trading with.
It just needs that little bit of a push to reach these levels sometimes. But to answer the question, the smaller time frame technical analysis patterns definitely do suffer from those news events because they basically ignore them.
Yeah.
Thanks, guys. And one last question. In terms of trading channels and double bottoms, as you mentioned before, you've measured distances of the channel and the bottom and sort of used them as profit targets. Now, would you aim for going for the 100% of the profit target, or is there a rule of thumb about how much profit you should aim for? Take 80%, 90%, 100%. Any rules of thumbs around that?
Yeah, what I like to do is, and it's a really good question again, let's say we were looking at this channel and we were considering a break and considering where we want the market to go. What I would always do is I'd always kind of cut my expectations probably down to about 80% of what we expect. And the reason why you do that is the market, or the people that trade the market, it's obviously human beings. It's a lot of people that have even their jobs on the line if they're professional traders. So they will generally cut their profits slightly shorter. And what we will see is the market will often stop around that 80% level. It doesn't always go on and continue the full 100% of the pattern. And that's where we want to be taking our profit as well.
At the very least, you need to be taking some evasive action, maybe taking partial profits off at 80%, but at the very least breaking even any trade that you've got in remaining, or at least having a trailing stop loss that's going to significantly contribute to the take profit that you're going to get. because we've got to treat it for what it is. It is the first place that the failure point will happen if it does reach there. So like Thomas said, quite often people do cut their profits short and say that'll do. So it's not so much we want to take a that'll do attitude, but we factor that in when we're looking at our risk levels in the first place, factoring in that the 80% level is actually a pretty good move, and as long as that is better than the risk reward ratio of more than 1 to 1, we're comfortable with that.
So yeah, pretty much 80% of whatever you usually expect with patterns.
Thank you very much. And that's the last question.
All right. Well, thank you very much, everybody that attended. Hope you enjoyed it, and we look forward to seeing you back next week.
Yeah, next week's a very exciting week where we're looking at swing trading. So yeah, stay tuned for that one. So we'll look at the live markets again and see what the market's going to give us next week.
And hopefully also in this account we can look at a couple of different opportunities, and we can report back on those opportunities and see how they've played out.
Actually, I think we might leave that USD in just for the sake of the exercise. The one that we just placed, looking at the retrace to that role reversal, we'll leave that in and see if that actually plays out for us by the time we come around next week.
Great. Thank you very much.
Thanks, guys.
Thank you.